This is your technical update from the LMAX Exchange Research and Analytics Desk for Thursday, December 24th, 2015. Euro dollar. So the key levels that you want to pay attention to above and below come in at 1060 and 107.96, and anything in between is classified as a choppy consolidation. A break back below 107.96 will open the door for an acceleration of declines towards the December low at 105.20, which guards against the more important critical March base at 104.60, which is a multi-year low. At the same time, if the market is unable to break below 107.96 and sees a push back above recent highs at 110.60, this will extend the correction out from December lows and open the door for a move towards the 113 area. Ultimately and overall, the downtrend remains firmly intact, but these are the two key levels that need to be paid attention to over the coming sessions. Sterling dollar. So cable remains confined to a broader, well-defined downtrend off the 2015 high at 159.30, with a lower top now in place at 152.40, ahead of the next downside extension towards the 2015 low, which comes in at 145.66. At this point, any rally should be very well capped ahead of 152.40, with only a break back above this level to compromise the current downtrend. Dollar yen. So dollar yen remains under pressure following the latest well-capped move towards 123.76, and a break below 120.34 will do a good job of accelerating declines down to lows that we had seen back in the 118 area, below which exposes the critical August base at 116.12. At this point, rally should be very well capped with only a break back above 123.76 to compromise the current bearish outlook for dollar yen. Euro Swiss. So Euro Swiss continues to consolidate over the past several weeks and months, though the broader recovery outlook remains intact, and any setback should continue to be very well supported above 107.15, ahead of the next upside extension beyond the September peak at 110.50 and towards 115 further up. Aussie dollar. So despite recent gains in Aussie dollar, the market continues to be very well capped on rallies on a medium-term basis towards the 74 area, with any rallies from here expected to once again be well capped in favor of the next downside extension and retest of the multi-year lows from August back in just ahead of 69. Really, only back above 73.85 would compromise this bearish outlook. Dollar CAD. So dollar CAD is finally showing signs of a correction off recent fresh 11-year highs just over 140, with the market pulling back below 139 and showing room for deeper corrective declines, potentially back towards the previous 11-year high from September in the 134.57 area. At this point, though, the broader outlook continues to favor additional upside, and once this correction plays out, a fresh higher low is sought out ahead of the next upside extension beyond 140 and towards the 145 area further up. Really only back below 134.57 would compromise the highly constructive outlook for dollar CAD. Kiwi dollar. So Kiwi has seen an impressive round of gains over the past several days, though the market is now trading into some key medium-term resistance, which comes in around the 69 area. Ultimately, a break above 69 would be required to force a shift in the outlook, while inability to do so will keep the broader pressure on the downside in favor of a fresh downside extension and renewed weakness back down towards recent range lows, which come in around the 64.30 area, below which exposes that critical multi-year low from August down and around the 62 area. SPX 500. So the S&P 500 is finally showing signs of topping out in 2015, with the market most recently being well capped ahead of the May record high at 2137, finding resistance at 2117. Since then, we've seen steady declines, with the market breaking back below 2000. This latest bounce, therefore, is classified as corrective, and a lower top is sought out somewhere ahead of 2100 in favor of the next downside extension below support at 2000 and towards the 1870 area further down. Ultimately, only back above 2117 would compromise the newly adopted bearish outlook for the S&P 500. Gold. So gold is finally showing the potential for some form of a base off those recent multi-year lows at 1046, though the market will need to break above 1100 to really convince of this base and open the door for an acceleration of gains. We are seeing signs of a potential double bottom on the daily chart, and the neckline of this double bottom comes in by recent highs around 1099. But again, to convince the possibility of a base, a break back above 1100 will be required to open the door for an acceleration of gains and to alleviate alleviate immediate downside pressure. Inability to take out 1089 or even 1100 will keep the pressure on the downside, with the potential for this to form into a bearish consolidation ahead of the next downside extension below 1046, exposing critical barriers at 1000 further down.